Hi, and welcome back. I'm Brian Anderson again from Annuity Straight Talk, and I've been getting up a lot of follow-up questions after the presentation, so I thought I'd record a video for everyone. When people first start looking for ways to turn their accumulated savings into income, they invariably run into annuities. But when you go online or look in a magazine, you're bombarded with loud opinions and what I think is a lot of misinformation. There are plenty of talking heads on TV and in print ads who scream, "I hate annuities and you should too." Well, this kind of rhetoric really doesn't help. It's just noise. Now, to let me be clear, I hate the kinds of annuities these guys scream about too. These guys selectively grab facts about certain annuities that are high in fees and low on benefits. You should hate these kinds of annuities as well. But you can't make a snap judgment about an entire industry based on a few selected contracts. The reality is there are a lot of good kinds of annuities that accomplish incredible planning objectives. Frankly, annuities can do things no money manager can ever do. That's a fact you can bank on. What money manager will offer you the guarantee that you can never, ever lose money? Not a single one of them. But that's just the point. Now, lots of people have been asking me, how is that possible? Seems like everyone is looking for a strategy that lets you capitalize on the market when it's good, but protects you from losing when it's not so good. But when you mention the word annuities, or even guarantee, they get their hackles up and don't believe it. They think it sounds like an investment is too good to be true, right? Well, in this video, I'll go over just exactly how this is possible to achieve. It's actually a lot simpler than you would think. There's no fancy financial engineering, just common sense at work.
When people think things are too good to be true, they get skeptical. And when it comes to your money in retirement, that's actually a really good thing. We always have supported that. You should be skeptical and ask as many questions as you can. I'm going to go through a few of the common questions we get to show you how annuities are guaranteed, who guarantees them, and also show you how you can go up with the markets but not down in a simple, safe annuity contract like what we use in our AST Flex strategy plans. So I hope to address some of the things that make people skeptical and give you a little straight talk to help you sort through all of the polarizing opinions that you're going to hear. So first of all, what does it mean when we say an annuity is guaranteed safe money strategy? Lots of people have some resistance to the word guarantee. But with annuities, we are talking about insurance, and guarantees are what insurance companies are all about. When you buy any insurance, you are shifting the risk of something bad happening to you, and you shift that risk to the insurance carrier. And the carrier guarantees they will do something for you in return for the premium that you pay. That might be a life insurance payout, property coverage for your home, or health insurance. Insurance companies are in the guarantee business, and guess what? Annuities are insurance too. Annuities are contracts written by insurance companies for your money. Annuities are nothing more than a guarantee that the insurance company will do exactly what the contract says. You buy all their strength, financial horsepower, and credit ratings when you enter into an annuity contract with their guarantee. So the value of the annuity contract is the guarantee. You need to make sure that guarantees mean something. For example, New York Life has more reserves than the entire FDIC. As the president and CEO of New York Life said when announcing their financial results, you can see on the screen, and I quote, "Whether the guarantees we provide are needed tomorrow or 20 years from now, our balance sheet shows a level of financial strength that says you can depend on us no matter what," end quote. This is the reason they use the word guarantee, and the reason why you want to work with only the best companies, so the guarantee actually represents something very strong. So annuities are about replacing risks and uncertainty with guarantees. It's risk management in its simplest form. And with great credit carriers, you can see how the word guarantee really means something when you are buying the strength and credit of a good insurance company. Therefore, you want to be sure that you clearly know what risks you want to shift. Insurance costs money, so be sure to get what you need and not a lot more. Now, another reason people are skeptical is because we live in such a volatile market. People think, how could any company guarantee something to go up but not down? Volatility is high, the economy is shaky, and rates are low. How do they do it? Well, with an index annuity you can, and I'm going to show you exactly how they do it right now. Here's the 30-second summary of index annuities so you know how they work and how they are the perfect vehicle for volatile markets and retirement planning. In summary, an index annuity, your money can go up, but you can never go down. This is possible because your money is in the insurance company's general account, and that's invested in ultra-safe holdings like corporate and government bonds, mortgages on commercial property, and this fund is designed to produce safe, steady yields in this market. That's 3 to 4% per year. Now, if you buy a fixed annuity, This general account yield of 3 to 4% would be credited directly to your account. That's the best you could do. But here's the key thing. Instead of taking the income in your fixed account with an index annuity, that income is invested in options in a market index. There are many different index choices out there, but the most common is the S&P 500. So we'll stick with that one for simplicity purposes. Options are wagers that give the purchaser participation in the markets and are a bet that the shares in that index will go up. If the market goes up, the options gain value and your annuity grows. If the markets go down, you lose only the price you paid for the option and do not lose principal. The principal always stays invested in those ultra-safe holdings. If the market goes up then down, the options and your indexed annuity may lock in some of those gains without riding down with the market. And finally, if the market is volatile and all over the place, you still might lock in some gains, all without experiencing loss and especially without the stress that goes along with watching it go up and down. Now, everyone knows the markets are volatile. You've all experienced this over the last several years. Here's a look at the S&P 500 for the last 15 years, from 1999 to the present. These were all your highest earning years and some of the most important years to you guys getting to the point where you are right now. As you can see, a $100,000 investment would have cratered to around $60,000 in 2002, only to climb back to break even by 2007. Find the bottom again in 2008, then march up and go up on the last 7 years. All in all, over 15 years, this is a volatile roller coaster ride. Today, if you were even able to hold on, you'd be at just $140,000 after all these ups and downs, which only represents a measly 2.2% effective rate of return over the whole term, with 25% swings up or down from year to year. That is not my idea of a good time. Now, by comparison, take a look at an index annuity with a 5% annual cap. Starting with the same $100,000, the annuity goes up in good years up to a cap of 5%. The real power is when these two come together. Can you see how powerful this really is? How can you win but never lose? This is the power of protected gains. Now, in another video, I'll detail the caps, participation rates, and spreads that govern how much of the market's gain you can get. But for now, the important thing is to see how this protects you from loss and how, in an elegantly simple way, this ensures that you can win but never lose. See, it's not too good to be true. It really just makes sense when you lay it out in simple terms. But a quick word of warning. We live in, work with, and scour the market every day and know the good contracts and the bad ones. I can assure you this is definitely not a simple task your local advisor is capable of doing. Getting the right contract and the right balance is a job for experts and someone who works with every contract in the market. Let's look at it year by year. Start with $100,000 in the market and $100,000 in annuity with a 5% annual cap on its potential gain. After the first year, the market's down and the index annuity stays even, so you protect your principal. At the end of 2002, the market had continued going down. You still haven't made any money, but you haven't lost anything. The index annuity has stayed flat because you protected your principal. Then 5 years of market gains, rocketing to year end 2007, the annuity caps at 5% per year, and the market, well, it's climbing pretty fast, but still not even back to your $100,000 yet. Meanwhile, the annuity has clocked gains up to $123,445. It's not too bad, huh? Then, 2008 financial crash. What does your annuity do? That's right, it's protected. It doesn't go down. It stays flat. Meanwhile, the market's nosedive 38% that year alone, and the cumulative value of your $100,000, if invested in the S&P, is now just $61,476. But since 2008, we've had a solid market climbing steadily, but flat for the year 2011. How did things turn out? Well, obviously, because you didn't have to start from the lower point, the index annuity climbed right along with it and increased even further. So even with the market tear in the last 3 years, the slow and steady 5% capped annuity outperforms the market overall. So we've seen the power of a guarantee, and we've seen how a financial contract that lets you go up with the markets but not go down leaves you well ahead of the markets. The final question we get a lot is about getting locked in. People often dismiss annuities because there's a contract and a surrender schedule. But let me be the first and probably the only annuity agent to tell you that you should avoid getting locked in for extended terms. You can't avoid some contractual terms and timelines, but you should avoid long-term, lifetime locked-in commitments unless absolutely appropriate and necessary. Like we talked about on our webinar, we feel that long-term contracts are almost never in your best interest. It's a very specific use for a very specific person. But you have to keep your money safe too. Often liquidity and flexibility are on the opposite ends of the spectrum from safety and guarantees. The optimal solution then is to keep your money safe while still keeping your options open, and nothing does that better than the AST Flex strategy. Flexibility in the world of annuities and the AST Flex strategy in particular means finding the shortest contracts out there and also the best growth components available so that in the future, if rates are better, you can simply move your money and ladder into a better deal. Flexibility is the most important thing that you can have because too many other advisors just push the forever lifetime income contracts, but I know if you get into one of those, you'll have no way out in a few years. So do you remember the late 1970s and early 1980s? Bank CDs were paying 15% and even as high as 18%. Inflation was raging too, but looking back, wouldn't it be nice to have locked in 10, 20, even 30-year CDs at those rates? It might have been the investment of a lifetime. You need to keep your money safe and yet stay flexible. Flexibility today is what can make a deal like that tomorrow an option for you. So keep your options open while playing it safe. And this is exactly what we focus on with the AST Flex strategy.
So you see, the AST Flex strategy we talked about on our presentation uses simple annuity tools to produce a great safe income with flexibility, profitability, and options. It isn't something that's too good to be true. Really, we are able to give you a great solution using the best of what the insurance companies offer, and we keep you out of riders, contracts, and gotcha provisions that you'll regret in the future. Like I said, it's not a job just anyone can pull off, but best of all, the Flex strategy is a smart, safe money plan that is specifically built for volatile markets, so you can guarantee that you never lose money no matter what happens in the markets. So if you want to learn how to maintain the highest level of flexibility for your assets and earn a great safe yield while staying out of fixed forever contracts, then the Flex strategy is exactly what you need. All you need to do is make an appointment to get started today. I look forward to speaking with you, and thanks again for your time.